Welcome to today's episode of the Pursuit of Excellence podcast. Today, I'm so excited to have a repeat guest. Today, we have Evan Gruchot, the founder of EG Capital Holdings and Chief Investment Officer. So today, we are going to be diving into debunking financial myths. Very excited about this because this is probably something that we deal with on the daily. Every single day, every single conversation, we are constantly overturning objectives or reshaping people's perspectives on why things should be considered one way or the other. I'd love to just start right out the gate and talk about why all advisors are not the same.
Yeah, and I think some people will have that experience first and foremost when they've met different financial advisors as a whole. I think there are advisors that are more insurance focused. I think there are advisors that are more retirement focused. There are advisors that are even just debt focused. Like you can have people that will brand themselves as like debt restructuring advisors, things like that. You've got the David Ramseys of the world. Funny enough, I got called by them from way back when. They're like, "Hey,
the debt snowball.
do you want to come in and be one of our strategic advisors in our program for our firm?" And I told them that, hey, with who we work with and everything, it's not really the fit
as
anymore.
Far as the investment philosophy and whatnot,
relative to the type of clients that they deal with. But I guess we'll start kind of your bare bones advisor that is when they're maybe first starting off in terms of what does their practice look like? How do they typically work with clients from a coaching perspective of training advisors as if they're joining a firm? They're typically taught, hey, stick to a niche and find that niche. So working with teachers, working with everyone targets business owners, high net worth investors, everything like that. But at the end of the day, from an advisor standpoint, people still need help with their retirement planning, which is very common. And we'll dive into that in a little bit as the main focus. But you'll have advisors that are more insurance focused. So they're the whole life insurance, the IUL, the infinite banking type strategy of, hey, here's a product that can solve some problems that you might have and is a useful financial tool. I'm not here to say that insurance isn't the greatest. And I know you and I have had this conversation many times is, hey, insurance can be a perfect tool when used. I would say from a basic financial planning standpoint, insurance should be a part. Just like it's legally mandated that you have car insurance. It does make sense in a lot of cases to have insurance. Now, what that insurance looks like, sometimes it's life insurance, sometimes it's self-insurance, in all fairness. If you have a $10 million net worth and it's all liquid, you probably don't need life insurance and you're self-insuring. That's still insurance. That's still making sure the concept of insurance is still taken care of. And so
I'm so we could the funny part about financial advisors is also because of their preferences around how they mitigate risk.
Mm-hmm.
So it's also just trying to find philosophy fit, licensing fit. Advisors who have different licenses can provide different products.
Absolutely.
And so understanding, where they house their licenses. Are they just charging a fee to charge a fee and not actually able to solve all the variables that you've brought to the table? So for us, so the self-insurance, see, for me, I like to at least have the conversation around if they would like to consider the legacy planning side of it. So if they are incorporating estate equalization, insurance is a great option, or charitably inclined, including insurance into somebody who is a higher net worth or ultra high net worth is an important conversation to have.
Absolutely. And that leads to the point I was talking about where it's hey, where is the product specifically fit? And you raised a really great point about licenses as well, because that also leads to the different type of financial advisors that you'll meet with. You'll have advisors that are appointed to a broker dealer. You'll have advisors that are appointed to a hybrid structure where it's broker dealer and RIA, or registered investment advisory firm. And then you'll have advisors that are just registered investment advisory firm. And the key factor, at least legally in that aspect, is what are they required to do in terms of how they act on behalf of you. So if they're just registered with a broker dealer, they have what is called suitability standards. They're not required to act in your best interest. So this is anyone that has whenever you're looking to hire a financial advisor, and I might have said this on the last one, look on FINRA Broker Check and check their licensing. Check to make sure, hey, are there any disclosures? If you have an advisor that filed for bankruptcy in their past, you might not want to talk to them about managing your money.
Or has a complaint filed against them.
Or a complaint, and if they're talking about the same sort of things in your plan, I'm not saying don't hire them, but definitely ask about it. Make sure that you've got the full picture, the full story, because it's easy to file a complaint. I will preface that. It's very easy to file a complaint against your advisor, and it still flags as a record, even if it is a case of that the complaint, like the advisor was in the right and everything, but it's super easy. And we live in a vindicative world right now. And so that is
but not to harp on that, but at least like it's a talking point. It's just going in with your eyes wide open so that you can vet the person that you're trusting to give you advice.
But on the suitability standard, they have to find options for you that could make sense for your plan. It's not necessarily the best option for you. It is just options that would work within that plan versus the fiduciary standard, which is you are in that RIA registration where you are legally required to act in the best interest of the client. Now, at the same time, that's gotten a little loose as well. You have, if you have where you can act that, hey, this product still makes sense within the plan, it still is in the best interest, but you'll meet 4 different advisors that will approach portfolio management differently. They'll approach insurance differently. All those products will work within a plan. And they can still be in the best interest because it still touches on that. But it doesn't factor in, hey, is whole life insurance the best in this? Is term insurance the best? Is a stock portfolio the best? Is a bond portfolio the best? They can all work together. So it all comes down to you and your specific individual situation. And there are going to be multiple solutions that fit for that. And so it comes down to what is your risk tolerance relative to that.
We always like to say, like, you can skin there's so many ways to skin a cat. I don't know where the semantics on that etymology is, but that's basically the approach is like when you come to an advisor, they're going to do a full fact finder to understand, and they might not, but hopefully they do. They try to understand your entire gap analysis and then figure out what are we solving for. And so certain products also, the advisor gets paid differently if they're placing products on your behalf. So just making sure that even within that suite of products that is suitable to solve for your goals and objectives, understanding how the advisor actually gets paid on the product as well, so that's another talking point to understand their recommendations.
And how they get paid is also different as well. You'll have advisors that get a percentage of assets. You'll have advisors that do a flat fee in terms of how they bill. And then you'll have advisors that will do a performance fee sometimes as well.
We get asked about our fee all the time.
Our approach is technically separate. We have our consulting entity that is not related to any of the financial planning and portfolio management work we do. That's all done through the RIA. Those fees are all very clearly outlined. Where we're working with clients on the consulting side of things is truly a consultative approach where we are coming in and we are providing unbiased advice. We're going, hey, you can go do this yourself. This is how you should do it. It's more if you want us to do it is where then it comes into any additional fees and outside and things like that. But on the fee-based approach, you'll typically have an advisor based on the scope of work. They'll figure out what their hourly, similar to an attorney, where, hey, we have this hourly rate. You have to pay us this retainer. We draw against that retainer. And it typically is based on the size and scope of the work that they have to do for you. If you have a $20 million portfolio and you want a really complex plan put together and strategies implemented, they're probably going to charge a higher fee. But at the same time, if you're that $20 million portfolio and you are in a asset-based fee, make sure that your structure matches that fee percentage. If they're going and they're saying, hey, we should charge you 1% on that $20 million, that's $200,000 a year in fees that they'd be collecting. And all they're doing is direct indexing you into the S&P 500. That's not really, hey, I'm getting my $200,000 worth of value.
Yeah.
Versus if you have a $20 million portfolio, there are algorithms that'll do that. Schwab will do that for you automatically. There's robo-advisors where they'll charge 5 basis points, 10, 15, 25 basis points. I think is the highest I've seen a robo-advisor charge for something.
Yep.
And so make sure you're getting enough value in that instance and that impact. And what you are paying for, I think, is the other thing. Are you just paying for retirement planning, or are you paying for financial planning?
Yeah.
I know that was kind of our next
topic.
topic.
Well, so the thing I love about our approach, and, you know, we've seen it done every which way at this point. And so, you know, when we were talking about our business model, it's really about like making sure that we do like you just said, we do have an unbiased approach. So we charge a fee for the overall plan. And then as far as the recommendations, we'll support you if you want to utilize somebody else to go implement it for you on your behalf. Or we will go source what the actual implementation looks like. So it's just making sure that you are cognizant and aware of the functionality of everything that we're putting into place. I think that's really what separates us from a lot of other advisors, is just the fact that we're building the plan holistically from every angle, and bringing in the other professionals to be able to implement, from everything from the CPA, the accounting, the attorneys, to help support and quarterback the execution side.
Yeah. When you think about financial planning, I would say it's different ways you can work with someone. And that goes back to the advisors. So retirement planning is obviously the most common thought of, hey, well, and young people in particular are going, well, I don't have to worry about retirement planning. I don't need to think about what that's going to look like.
Yeah.
But when we go into the other areas of financial planning, there's a lot that could be applicable to that person. Mm-hmm. So we do probably way more than we should.
Agreed.
I would say, for clients. And I think it helps with building long-term relationships.
Absolutely.
But when you are looking at different aspects of financial planning, so you have things like insurance planning is, hey, what insurance that I'm offered through my employer, or if I'm an independent self-employed person or for my business, what insurance options do I have? Is, hey, I'm a really young person. I'm super healthy.
Yeah.
You don't necessarily need a PPO plan, because I would be paying more in premiums and I'm not going to the doctor. I go to the doctor once a year. Why am I paying extra in a PPO versus you could still end up funding around the same amount of money, but you do a HMO with an HSA attached to it. And you're funding that HSA.
I love an HSA.
And you're getting the tax deductions there.
Yeah. And
you're building up this bigger bucket that allows for, hey, if I have an appointment that's I have to go in a couple times, or I have this unforeseen expense, you've prepaid that. You don't have to now pay that out of pocket.
Yep.
First and foremost. But in the more likely scenario, if you are somebody that's in your 20s, you're not going to the doctor that frequently, and you don't need a PPO. Versus, hey, I'm in my 50s, I have 5 checkups every 3 months.
Yeah.
Then PPO makes more sense. So little things like that. Also, taking advantage of looking at where your bank accounts are. Mm-hmm. Are you at a community bank versus a big name bank? Oh, you're at the big name bank because you opened that account when you were in college? And that was, this is my own personal experience
same.
here.
I'm laughing because I still have a Wells
I had
Fargo.
my local bank and it worked great. And then it was, well, now I'm in a totally different city, totally different state, or I moved.
Yeah.
And Wells Fargo was right down the street.
Yeah.
So I know I needed a local checking account where I could go and get money from an ATM. Is, okay, well, how often do you draw cash from an ATM?
Yeah.
Never.
Never.
Oh, well, then why do you have Wells Fargo when your interest rate on your checking account is or your fee on your checking
Yeah, the
account?
fee is wild.
We get a lot of clients where, hey, I have a business checking account and, oh, you're paying $15. Do you know what you get with that $15? They go, no, that was kind of what they said makes sense for me. And we look in and it goes, well, you're paying $15, so you get unlimited ACH transactions. Then we look at your bank account and we go, you have two ACH transactions a month.
Yeah.
They have a free version of that account that you have to pay for the ACH transactions. But if you're doing 2 a month, it's costing you $5 versus $15.
Yeah.
And so little things like that, that's still financial planning.
Yeah.
Believe it or not.
Funny.
Same with, hey, I've got all this money in my checking account. I've met people that don't even have savings accounts.
Well,
I've got all this money earning nothing for me.
Mm-hmm.
And I've got my emergency fund. At a minimum, your emergency fund should be in a money market or a savings account where you're getting some interest on it because it's still liquid, it's still accessible, it's still available to you. That's still financial planning.
Yeah, interesting.
Same with debt management. Hey, I made some mistakes. I bought a car and I didn't have great credit, but now I have really good credit. But I'm still paying 8-9% on this car loan back when right now I could refinance.
Yeah.
Or I can go in and pay that off with the existing cash. And so debt management, because not all debt is bad either. Yeah. If you have credit card debt, it's typically bad.
I think this is a conversation, like the debt conversation is one that we have all of the time, which is like defining the difference between good debt, bad debt, and then the spread. Yeah.
And I think the greatest example of good debt is real estate investments for your personal primary home.
Yeah.
Because if you are paying rent, and this is a math problem, first and foremost. I'm not out here to say, hey, you should always buy and you should always own a home. You should always rent. It's a math problem based on where you live.
Yes.
But there's a ton of free calculators online where you can figure out, hey, does it make sense for me to buy? Does it make sense for me to live? But the way a mortgage traditionally is, you have to be in that house for about 7 years for you to break even relative to most of the mortgage. It's interest costs up front.
Yep.
So before you even really start chipping down at that principal, you got to be in that house for 7 years. So if you're a young person, buying a home sounds really solid, sounds really great. But if you're somebody that's planning on moving every 2-3 years anyways, buying a home's not going to be the right financial decision for you. That's also still financial planning.
Yeah, the taxes alone on a house that's not your home.
You're going through that now with the property tax aspect of it. But the cost of, hey, now I have this mortgage, but now I get a better home, or it's less than I was renting. Yeah. That's good debt to take on, and you are building equity because it's backed by an asset.
Yeah.
As opposed to traditional like credit cards, things like that, when you're buying expendable goods or you're buying food and things that are not having any value around it. And I'm not saying don't use a credit card by any means.
Like we literally use like debt for everything. Yeah. We finance everything.
Yep.
So it's just
and
being responsible.
I think also we talk about like the different aspects of financial planning too.
Yeah.
And there's a ton of really great resources on this nowadays. NerdWallet, Bankrate.com, The Points Guy.
Yeah.
But credit card utilization now is an aspect that I personally would consider as part of financial planning. Absolutely. Not only like, hey, how am I using credit cards? But if you are someone that uses credit cards, making sure you're using them properly and taking advantages of it.
Oh yeah.
I think the greatest example, and I don't even have an Amex card here. I like my Chase card and my Bilt card. But hey, you're paying rent.
Yeah.
Already, the Bilt card is great, and we're not advertised on any of this, but the Bilt card's great because why wouldn't, if you have to pay the rent anyways, and this is the whole reason why they're breaking off from Wells Fargo. Wells Fargo is not making money because this was such a great program.
Interesting,
is, hey, I have to pay rent anyways.
Yeah.
Why wouldn't I get some of that back through credit card points or through cash back or anything like that? And so, use the Bilt card for that. And now they're rolling out something for mortgages
That's awesome. So
Two.
I actually downloaded the app like Max Rewards so that I could see what rewards, like where I was on the thresholds to make sure that I maximize the usage of all the cards.
Yeah.
Yeah.
Well,
It's
the
been
Amex example.
Yeah.
You're out to eat. Oh, the platinum card sounds really fancy. But your gold card
The
gets
gold
more
card
points.
is better.
Your gold card gets you
For
more
groceries
points.
as well. But if you download the app, and I just learned this, Rakuten, it'll multiply your points depending on the company that you're going to shop
Every time
at.
I use a Lyft,
It's like wild.
Every time I use a Lyft ride, I pay with my Chase card. But I have it set up to my Bilt card, so I'm actually getting points on my Bilt and my Chase, even though I'm not paying with my Bilt card. Because they have Lyft. Chase has a program with Lyft through that card where you get benefits for not like you get either discounted rates or you get an upgrade to like comfort if you order the regular, or you get 5% off your next 10 rides every month, and it resets all the time. But the Bilt card, you just get points for it as well.
So the challenge though is that if you're financing your life, is playing the interest rate game.
Yeah, it's all about opportunity cost. So if you pay your credit card on time, it's not a problem at all. But if you are someone that's going to start carrying debt, making sure that debt is linked to something. So you have a mortgage on a property, you have a rental property, and you're cash flowing 6% a year on that rental property in terms of what the mortgage and the total cost and everything would be. If you took out debt to finance that and it's at 7%, you are losing 1% a year unless the asset grows significantly as well. And so it's just a math equation. It's why I love finance. It's all math at the end of the day.
So it's just interesting because then we're having the conversations around like personal loans or taking HELOC or understanding leverage for just the putting it into something that's creating a larger spread like private credit where you're able to make 15 to 20% on interest. And so then we're looking at the delta of what that overall return would be when we look at the overall ecosystem.
Yeah. And it also, if you are going to leverage yourself, because there's people that aren't comfortable with leverage, and that doesn't mean you can't do certain things. If you are going to leverage yourself, make sure you do it strategically, make sure it makes sense. Sometimes your lender also, if you are looking at a securities-backed line of credit and everything, won't allow that to go to certain funding. Because they'll have different terms. They'll say, well, this is actually more margin. If you're using this just to buy more stock in a different brokerage account, that's going to void what our lending agreement is, because technically that's margin. That's not securities-backed line of credit or a HELOC or anything like that. So that's important to factor in when we're looking at debt. Also, it's important to look at for debt is the life of the note that you're taking on relative to your credit score as well. If you're taking on a really high interest short-term debt, then that gets paid off pretty quickly. That would be the recommendation first and foremost in a lot of cases. But we have a lot of people, they'll take on an SBA loan and they're going, well, I hate debt in my business and I want to get rid of this. And we go, well, your interest rate on this is 4%. And we look at your business numbers right now because yes, you're doing great. But if we're able to redeploy that back into the business where your business is doing 20% net profit margins, not gross profit margins, net, that if you have a 20% net profit margin, that means you have a 20% rate of return on your business. So don't prepay your SBA loan unless it's something that's higher. Or unless you need it strategically as well, because you could prepay it and go, well, that's 4% now and my profit margin goes up. Maybe we can prove that, hey, if we do pay this off because your monthly payments may be a little bit higher, then now our profit margin shoots up to 25. Then do it.
So it's just understanding the type of debt and then being strategic around the overall utilization of funds. So I actually want to debunk investment is like gambling. What are your thoughts on that? We could literally spend probably like 3 hours on this,
Yeah.
but just like as like a
I
baseline,
think it
like
depends on the type of investment.
yeah.
0-day option expirations
Let's just talk
is
like
gambling.
S&P 500,
Yeah.
like basic. So like, let's say college student, graduates, they want to start, figuring out what to do with their life. They got a career, they're starting to make money. It's like, I always like to think about if you're not investing right out the gate, you're losing out on compound interest just as a fundamental baseline, like strategy altogether. So just simply dollar cost averaging and then taking advantage of compound interest as is there. There's there's a joke. It's not a joke, but I find it humorous. Um, when I first got into the business, I learned it. So and you can correct me if my factual information is hearsay at this point, but the people that have done the best in the market are the people who forgot that they had the accounts and never touched it. They forgot their login and never touched it, or they got really great advice to never touch their account.
That is super true for the people that invested in Bitcoin back in 2008, 2009. But I think there's also people that have just totally lost their logins entirely. And that Kevin Durant, that happened recently, and he had a couple million because
In
he
the
bought
Bitcoin?
Bitcoin back
Oh,
in,
interesting.
it was like 2015 at the latest, I
Yeah.
think. Still something where it was maybe 10, 20,000 when he bought it. And now
Funny.
Bitcoin's hovering between 90 and 110.
But for just normal investing, like, so when people who are not educated about investing, they're like, oh, I've got my 401k, I've got a Roth, I've got a TOD fund with Fidelity, like,
Yeah. I think retirement
yeah,
offerings, especially through your employer, are awesome because it is, and in that case, and the big thing a lot of people talk about is, well, I have my Roth IRA, I put money into it, and that isn't investing. That's just funding an account.
you actually need
But
to
the
go in and
401k
trade.
is actually a little bit different. If
Yeah.
if you left it in cash, but you had an employer match,
Yeah.
you actually did make money in that instance.
Yeah.
And so it takes the gambling out of it in that instance. If you have a 401k and you have an employer match, where if you're making 100,000, you have a 3% match, you put in 3,000, your employer puts in 3,000. You made an 100% return on your money right there.
Yep.
That's not gambling by any means. Now, the common, hey, I'm gambling with my money, is because the stock market does go up and down, just like any investment itself. Now, I'd say the difference between the stock market and gambling is an all or nothing.
Zero-sum
It
game.
is 100% or zero in terms of whenever you make a bet, is I am either winning money or I am losing money. And so, and this is the crazy thing, because now there's hedge funds that are doing this. They're hiring really smart gamblers and everything and building entire funds around this, because there are ways to do it. I'm not saying that, hey, this is something people should invest in, but I think it's very popular now. There's a lot more people that are doing sports betting than investing in the stock market too. So I would say if you're sports betting and you're pursuing these really high rates of returns, then there is inside the stock market that same feel of all or nothing, and that's called zero expiration options trading. So same day on the S&P of, hey, the market started at trading at 500 for the day, and I'm betting it's going to go up to 505.
So it's funny. So with the gambling side, I actually found some statistics. So the probabilities of winning various casino games. So craps, 50%.
Yep.
Blackjack, 49%. Roulette, 47 to 49%.
Yep.
And then Baccarat is 44 to 46. But with the probabilities of the S&P 500 with the returns over 5-year periods, since 1955 is 81%. 10-year periods since 1960 is 92%.
And 15 or more
15 or more is 100.
Yeah.
So literally just leave your money.
So I think the big difference is you're not investing in a all or nothing.
Yes.
There is value relative to the companies. If you are somebody that is constantly going and shopping at Target every day for your groceries or every month for your groceries, you know that Target will have a customer and will have revenue that comes in.
Yep.
It's not going to go all the way down to zero. And so it's not an all or nothing. There will be fluctuations. There will be changes in, but the stock market is seen as a hedge against inflation over a long period of time because companies, in order to survive, in order to maintain growth, they have to outpace inflation in their growth. They have to continuously grow. Otherwise, they are rendered zero and it ends up net zero.
Yep.
Now, the really interesting thing is the S&P 500 as a whole. If you look at the companies that have made up the S&P 500,
Yep.
we have not had the same mix of companies over a long period of time either. You look at companies that are currently in the top 10 in the S&P 500, they were not in the top 10 20 years ago either. And so investing is strategic, which I think is where the difference between gambling and strategy can come into play. There's a lot more you can do with investing. You can diversify yourself significantly more than just this all or nothing. And there are aspects of investing that do feel like gambling, that do feel like, hey, I've got this positive for an up, I've got this positive for a down, or possibility for a down. But it's more on the longer term side of things that you will have that growth or that downside compared to gambling is a one specific environment that ends up with it boom or bust. And so it all comes down to how you are allocated in your diversification, because same thing if you, and I know this is not where you were going with it
we
either,
are going wherever we want to go today.
Same way, if you technically had infinite money on sports gambling bets, you could go and place thousands upon thousands of different bets on scenarios that will happen. Like they're all zero sum. Something will happen in terms of either this team wins or this team loses. And you will have a more diversified outcome. The more bets you place, the more things you do. Where I would say it's more gambling is when, hey, you're putting all of it in on one result.
Super concentrated,
or you're putting a parlay in place where I need 7 results in a row to happen just for me to win my money.
Interesting.
Back itself versus spreading it out across 500 companies, across 10 companies, 3 companies, everything. It's concentration risk. And so the more concentrated you are, the more it does feel like gambling. The more diversified you are, the more possible scenarios where you could win are going to be possible. So there is,
so it's like the difference between like investing in an index fund versus leveraged equity, right? So it's like how many positions are inside of an index fund versus like how you approach our leveraged equity sleeve, or like, so
more of our tactical equity where it's concentrated stock positions, things like that. Leveraged equity is the index funds. It's just that becomes closer to,
it's just about understanding the higher return that you're looking for. It comes with risk, and so how do we offset the risk is really coming down to the person that's doing the trades and the strategy behind that to really mitigate the potential downside. So I think that's like the huge difference between just going for mutual funds and indexed funds, like with the S&P 500 with your Fidelity account, versus using somebody that's an active manager as well.
Yes, and I think it's also important to note that there's a wide discrepancy in active management as well. You have people that on the passive side, on the index fund, there's not a ton of discrepancy. On the active manager side, and we can look at hedge fund traditional returns, we can look at different large cap growth investors and small cap investors. There's a huge disparity in terms of active management. And that comes down to your personal due diligence process, your comfortableness with the person that is managing their strategy, their investment philosophy for that strategy. And that comes back into not all financial advisors are the same either.
Exactly.
And so you have to make sure that your philosophy aligns with theirs.
Yep.
Because they might go and say, hey, we like all equities. We don't like bonds, anything like that. And here's why. And here's the risks that we're taking on. Here's the positives and the gains. And you might not feel comfortable with all the risks.
Yeah.
And so you got to find the right advisor for you in that aspect.
I love it. So as we wrap up, what would you say like your like fundamental recommendations for how to choose an advisor? What would that look like?
That is a great question. The first thing I look for, like, I obviously manage my own money. But if I were to hire somebody, either to work under me from a portfolio management aspect, or if I were to go hire somebody to offload my stuff, what I would look for is first and foremost their knowledge base.
Yep.
And are they continuously, because we're in ever-changing environments, especially now more than ever with now advances in technology and things like that, is, hey, you have to be willing to admit when you're wrong, or that, hey, your knowledge can get better on a certain topic.
Yes.
As a whole. So I'm looking for someone that not only is super knowledgeable relative to what they've done, but is constantly looking to learn more.
Agreed.
Itself on new products, new things. So I would, as part of my like qualifying questions is, hey, if you looked at an advisor and they have no experience with crypto and you ask them, hey, what if I wanted to do investments in crypto? If their immediate answer is no, we don't believe in crypto at all, that is very close-minded of, hey, this is what I've done. It's worked. It's that. And you are potentially missing out if you're someone that says, hey, I want, like, this is me personally on that front. But if they're not open to any of that type of stuff, or saying, hey, we research it, we look in terms of where it fits within your portfolio, making sure it's aligned, making sure we're educated enough on it to speak to you on it, that's a red flag for me right there. I would also look at what are they doing with their personal funds as well. Financial advisors are known as and portfolio managers are known as some of the worst people when it comes to their personal wealth management.
It's true. It's wild.
Itself is, hey, where is your capital aligned? Where are you going in? Are you invested alongside these deals for me? Especially on these, like,
I think that's
the
the
people
question
selling
that we get
annuities,
all the
selling
time.
insurance is, do you have the same insurance product?
Yeah.
Why does this make sense for me if it doesn't make sense for you? And they should be able to explain that, because it might not make sense for them in their specific situation, because you guys could have different situations. Unfortunately, a lot of people gravitate towards financial advisors that are in the same state as them. Or I see people, especially younger, that go, well, I'm going to go work with this financial advisor because they've made all this money. They've done all of these things. And that might not be the right fit, just because, and I'm picking on one of my buddies here. I don't know if he listens to it, but he goes, my financial advisor drives a McLaren. I know what he's doing with his money. And I go, yeah, I'm not going to step on toes or anything here, but that should not be the reason you picked him as your financial advisor.
Agreed. No, it's really interesting to just segue on that one. It's really interesting to challenge advisors, especially around their recommendations. And this is something that we get asked all the time is, are you guys invested in this? It's like, so when we're doing the private credit conversation, it's like, are you guys invested in this? Like, yes. Are the tax strategies that we bring to the table to support overall strategy and work with their CPAs to see if it's an alignment. Are you guys invested in this? Yes. And
if we're not, we explain why.
Yes, exactly.
As well, because it might be, hey, we took advantage of this other one because it was more applicable to our situation.
Exactly. So it's like we're happy to make sure that the audit defense is fully communicated across the board when it comes to the strategies. But yes,
I think it also plays into the other factor. We've become much more in the, here's all of the possible ways we can take this. To your point about multiple ways to skin a cat, is the differences on what options they have. And a lot of clients will ask us, hey, what can I do? I come to them with, here's different scenarios not just here's the one recommendation. And I think that's also really important to get from a financial advisor, because so many people think they're looking for just tell me what to do
Mm-hmm. Yes.
versus educate me on my options.
Yes. I
And
think
then help me make the decision which is the right based on all the options. But it's important to know that there's multiple ways to address a situation.
I think the thing also that you lead with is like robust education. So like people that are coming to you are prepared to drink from a fire hose to understand that there are so many
You
options.
hate it because our sales cycle is so long.
It's not that I hate it.
I'm
It's scared.
kidding.
No. I have a reaction to it because it scares people.
Mm.
Right? To your point, people want to be told what to do. They don't want to know why they need to do it or how it works. But like as a fundamental like rule, as a fiduciary, you have to understand the recommendation so that you can justify why it's been implemented. So you don't need to know how the watch like is built, but you need to know how it functions.
Mm-hmm.
So it's but yes, the people get scared. And so that's my reaction to it is just like you have to prepare them, mentally prepare them that this will be an analytical exercise before you can actually get to all right, what do you actually recommend?
Yeah, absolutely. The key points are making sure you're comfortable
Yeah,
with the process that advisor has. Where I know I'm not the best fit for everyone
sure.
we try to talk to, but our focus and when we are working with a client
Yep.
is that it is a good fit
Yep.
too. So that's kind of wrapping it all together. Not all financial advisors are the same. Is making sure that their approach, their education approach, their advising approach aligns with you. Are you super analytical? Because strangely enough, is advisors that are super analytical attract more of the creatives as their clients, because the creatives are looking for someone that's going to have that knowledge base and make sure that that aligns and they can know, hey, I can feel safe, I can feel comfortable that I don't
That you
need
know
to
what's
worry
going on.
about the
Yeah.
knowledge base. And the more creative financial advisors tend to get more of the analytical because they like to do the due diligence and everything themselves. So the creative just brings them, hey, here's some options. And then they can go in and they can make their decisions
Yep.
themselves. And so it's important to make sure that you are aligned on process, you are aligned on their knowledge base, their consumption for knowledge, that you are aligned on investment philosophy, and that you are aligned on product usage
Yep.
as well. Because at the end of the day, any financial advising is products.
Yep.
Whether it's a investment management account, it's stocks, it's bonds, it's annuities, it's structured notes, it is insurance, it is private credit, private equity, venture capital, real estate.
Yep.
All of that has to align with what you're looking for.
I'd also say I would challenge you if you're using an advisor who's a one-man band. Like having a team approach is significantly better across the board to maximize the talent that you have on the team, as far as just overall process, execution, implementation, strategy, eyes on strategy, and really just having the think tank on strategy before recommendations are actually made to the client. So I think understanding the overall operation on the back end of the advisor as well, and fee structure. Like you got to understand, for us, we really like to demonstrate the return on investment for our fee structure, so that you understand exactly how we are essentially paying for ourselves, right? So it's really just trying to understand the alignment across the board, personality, process, fee, overall just expectations on output.
Yes, and I think performance fees, I know we touch very frequently on that, but performance fees also can align
Yep.
the advisor with the client in terms of, hey, I don't get paid unless you are generating a minimum of return or
Yep.
anything like that. That's important. And at the end of the day, when we're talking with a lot of our clients, we're not doing the traditional like approach or anything like that. It's all consultative to where
it's like bespoke.
yeah,
Like everything is
it's
bespoke.
super yeah,
I don't
it's
think a
super
single
custom.
conversation is the same in with any of the clients, because like our clients are coming in as business owners that are, revenue generating north of 2 million. They're building out their ecosystem, investing in assets. And if they haven't invested in assets, we're helping them build out where to deploy funds to achieve whatever their expectations are, to mitigate the taxes, to make sure they have cash flow if they need cash flow, and not over leverage them if they want it. But yeah, so it's like every single conversation ends up being super in the weeds, but we're doing the right thing by the client, so we can sleep well at night knowing that. So yeah, in closing, you want to sort of give the audience an idea of how we actually work with clients.
Of course. And I think it's something we really haven't touched on. And you and I have worked really hard to build out this process. And I think it's very different from a lot of aspects. As you know, our first call is an onboarding call.
Mhm.
This is after you've gone through, like, hey, this is what we think we can do. This is what we think we can implement. And the client has said, yeah, I want to become a client. I want to work with you. Our first call is an onboarding call. It is, hey, we're gathering any and all documents. And it's going to feel like you are giving us your entire life
Because you are.
because you are, but also because there's going to be areas that you aren't even thinking about that we're going to be able to help impact. So that onboarding call, we're introducing you to the CPA, or we're meeting your CPA. If you're saying, hey, I have one I'm really comfortable with, that first call is, hey, here's all the docs, because also it helps us. The CPA probably has some of those docs too. But then from there, we have a personal financial statement, lay of the land conversation. And it's just, here's where everything is. Here's where all that is in terms of your checking accounts, your insurance, your debt, your liabilities. And it helps because you should have that. If you ever need a mortgage, if you ever need bank financing, things like that, they're going to request that document. So that should be a living, breathing document
Mhm.
that we help you build out. And we go into, hey, where is this? What is this? What can we make? Small tweaks to start
Yep.
of just, hey, checking account, things we touched on today of the credit cards and the different types of accounts that you own and are they titled properly and all of that. And we're going through those quick little hits
Mhm.
first and foremost. Then from there, we're doing a full on investment audit. We're going in, we're saying, hey, let's take a look more deep into the weeds of how you're invested, making sure you understand what it is, and coming back with, hey, these are tweaks we think should be made, could be made. This is what's going well. This is what's not going so well for you. And you can take it back to your advisor, or we can start implementing those for you, or you go in and take it in yourself. We also then do a full on insurance audit. We have a great strategic partner there that comes in, takes a look at any and all private property and casualty, life, disability, health insurance, and we run quotes for you in terms of making sure you're not underinsured, making sure you're not overinsured, you're not overpaying for anything as well. And then we have a meeting on estate planning too, where we are going in, we're making sure that your estate plan, that you have it. And we run into a lot of clients that don't have one at all, but that we've got what we want things to look like
Yep.
first and foremost. And then we're helping you draft a lot of the documents because when you're hiring an estate planning attorney, that's the most expensive part is the drafting of those docs. And
Yep.
we've got a lot of great strategic partners in that area where we come, we build out a lot of the docs. These are built with the help of attorneys that might not have estate planning as their specialty, but then we can bring it to the estate planning attorney. It makes it for very quick turnaround for getting everything implemented and saves you a lot on attorney's fees
Nice.
as well. We then have quarterly check-ins in terms of, hey, growth strategy, talking about the business, the different consulting related parts of, hey, are we looking at hiring an employee? How should we structure that contract
Mhm.
for that employee? Are we looking at, hey, we have a bonus, we've got some extra money, we want to pay bonuses out. What should it look like? What should that percentage be? So we're doing that on a quarterly basis. But then a lot of our clients are coming up with different problems that might address, and we're coming in ad hoc at that point. They're scheduling meetings with us to then go, hey, I have this property that I have an opportunity to buy. What should I structure it as? What should I look at? Or I just got an offer to buy my business, and we're coming in, we're evaluating that. And I think that's a really cool process that your average financial advisor or business consultant is not doing at all in terms of making themselves so available, which is why we limit it to, like, you're not ever going to have more than 50 clients that you directly work with. I might not have more than probably 10 to 15 that I directly work with. Paul will only have 50. And then we'll expand our workforce and everything so that your time and every one of our clients gets a full week's worth of hours, 40 hours a year, dedicated just to them.
Love it. Amazing. Perfect. Thank you for being on the show. We're going to continue these conversations. So stay tuned. EG Capital.
Thanks for having me.
I love it.
Today's episode of the Pursuit of Excellence podcast, brought to you by EG Capital Holdings.